Welcome to the Stage Analysis Members Midweek video. It's Wednesday the 20th of July, and I wanted to start tonight's video by looking at the sector rotational model. I haven't looked at this since around the start of the year, when obviously I talked about the fact that the energy group was leading at the time, and based on the sector rotational model, that it was suggestive that we're in the later stage of the market cycle. We've now moved on. We've been in a stage 4 decline for a good number of months now. And so based on this theoretical model, we should be now moving further down the line on this into the consumer staples, the healthcare and utilities, and potentially the financials, as we're obviously moving quite far into a deep stage 4 decline. I mean, it basically overlays the two cycles, the economic cycle and the market cycle, in the fact that the market cycle tries to predict what's going to happen in the economic cycle. So you often hear in the news media about how the market tries to predict 6 to 9 months ahead. So this is basically that laid out in a visual way. So if we look at that at the moment, so where we are currently in a stage 4 decline, the expectation is for staples, utilities, healthcare, potentially financials, so we start to move into the later part of stage 4 to be leading. So let's actually have a look at the current period and see what's been going on there. So this is all based relative to the S&P 500 here. So if I get the S&P 500 up on this as well, so we can actually see what's been going on. Actually, no, let's do it relative to the S&P 500. It'll give a clearer baseline of what we've been doing. So last 137 days here, so since the start of the year, energy was our leading group, with staples, healthcare and utilities. So if we start to pull this in a little bit, you can see the change over time. So by mid-February, utilities were starting to catch up. Energy had come off quite considerably. You can see these staples and healthcare are still fairly strong there. A little bit of real estate coming in there. And then as we go through into March, see healthcare staples have taken over. Energy has come off quite a lot and moved all the way back down to more in line with the S&P 500. Utilities are still reasonably strong in there. Then staples took over. Energy has come back again, but you can see those groups were tended to be the strongest areas relative to the S&P 500. But we have started to see a change recently as we get into the last few weeks or so. Like, we've started to see some discretionary consumer services and technology starting to show again. But overall, in terms of if we take it over a longer period, just go back to the start of the year again, you can see that basically this is showing similar to what we would expect at this point in the market at the moment, with staples, healthcare, utilities and energy. So whether we're still early in stage 4 or whether we're moving in later into stage 4, it's doing a similar job to what it would predict. So I just thought that was interesting. It doesn't necessarily mean it's always going to be the case, but it has been fairly reliable over time. And so with that in mind, the expectation as we start to come out of a stage 4 decline and start to move into stage 1, early stage 2, would be that technology and discretionary would be your areas that would lead at that point. So that's just something to keep in mind for that. Right, let's move on to the next part of the video. So I did a fairly big post yesterday on covering what I consider to be the top modern books to learn the Wyckoff method. Someone said no books by Wyckoff himself in the list, but obviously there are a number of Wyckoff books that he did more than 100 years ago, and they are obviously very good in their own right. But for someone trying to learn the modern adaptation of the method, obviously these are the books that I would recommend to start with. You can obviously read the Wyckoff books as well, but I think just as a starting point to get you going with it, the Free Skills of Top Trading especially is a really excellent book by Hank Pruden. I think he died recently, but he was a great Wyckoff method trader. So he's a really good understanding of the method and really explains it well in an entertaining way in the book with good examples, with the jump across the creek and the ice story and other bits in the book. So if I scroll down a little bit, I've highlighted pulled out a few pages from the book just to give you a sample of what the book is like, so you can actually see. And the second book in the list is the Wyckoff Morphology in Depth. Again, another really good book. It's actually, I think it was written first in another language. The author is from South America, I believe, and so I think it was written in either Portuguese or Spanish first, and so the translation to English can be a little bit. I found it a little bit hard to read at times in some places, but after a few reads, I think it's just a little bit lost in translation in certain places. But for the most part, it's a really excellent book and goes through step by step through the entire modern adaptation of the method with all of the phases and the various entry points. Sort of here I've highlighted decision making, some of the tactics they talk about, where stop loss placement, etc. And then he's done a newer book more recently, I think in 2017 or 2018, which is called Wyckoff 2.0, which adds in some even more modern adaptations to the method, which includes volume profile and order flow. So it adds that extra dimension to how to use the method and how you can combine with those. So I think that's a really good book, and it also goes into greater detail of the Wyckoff structures and how obviously not every structure is going to be perfect, and how there's obviously lots of different variations on those and how to analyze those. So I think it's a really good addition and a follow-on book, similar to how Mark Minervini's books. The second book was much better than the first book, as it gave a lot more advanced concepts. So, and this one does the same for that. So for someone learning the Wyckoff method on its own, just the Wyckoff Morphology in Depth is a really good starting point, and then going into Wyckoff 2.0 as the follow-on book will give you that extra depth and much more advanced sort of techniques to do with it. Anna Cooling, The Complete Guide to Volume and Price Analysis, not a Wyckoff book per se. She does talk about Wyckoff multiple times throughout the book. It does use lots of Wyckoff techniques in terms of reading the price and volume analysis, but basically she goes through from a slightly different point of view. She does it more from an insider perspective. So where she shows, for example, on these examples, the buying climax and the selling climax, it's actually the reverse to how they're referred to in the modern adaptation of the Wyckoff method, as she's suggesting the buying climax at the spring, and the selling climax at the upthrust. So the opposite way around to how they're normally referred to, but there's lots of really good stuff on price and volume reading in the book, tape reading, so it can really give you some extra context and how to analyze price and volume action. And then finally, I did Trades About to Happen, which is a modern adaptation of the Wyckoff method. So again, another modern version, but he tends to focus on springs and upthrusts and absorption and bits like that. So it's a very reasonable book. I wouldn't say it's the best one on the method. Lots of people seem to hold it in high esteem, but after reading it, I found the other four books much more useful personally. But it is a good book in its own right, but just it wasn't my favorite one. Right, so let's move on. Let's move on to what's going on in the markets now. So S&P 500, starting with this, you can see we had a strong upthrust in the percentage of stocks above their 20-day exponential moving averages yesterday. There was a jump of around 30% yesterday. with multiple stocks breaking out. Another follow through day as such, as a continuation follow through day has been multiple through this structure. So the fact that it hasn't undercut since the original one, I think it was back here, or one of these ones back here, it's not undercut the ultimate low. So I think that one is actually still active for those that follow the cancelling method. But basically, we've been going sideways for a good part of the last month now, with a slight grind higher. So tempted to shake out last week, and then had a little bit of spring type action at the bottom of the base structure here. So we had a little minor spring type action underneath this more minor low. So local spring, little double bottom pattern forming here and attempting to follow through. The Nasdaq and the Russell 2000 did manage to break out to new highs, but above the local pivots. But the S&P 500 has only just managed to eke a slightly higher high today and back above that 180R level. So in the short term, it's starting to look a little bit more positive, starting to hold above that 50-day moving average, but we want to see it continue to respect that 50-day moving average and show a bit of follow through. As if it starts to dip back below that again, if we get an immediate reversal back below, then obviously that would be a negative, and we could fall back into the range and potentially complete a bear flag and make a stage 4 continuation breakdown. So looking for this to continue to move up into the higher ATR levels here, so through the 2 ATR level and potentially up into the 3 ATR level, and then start to respect that 50-day moving average and a bit of tennis ball action to continue up. And for the short-term moving averages to start to get back above the medium-term moving average there. As you can see, we're still well below the 200-day moving average at the moment. Still a long way to go back up to there, another 10% yet. So a lot of overhead resistance in order to get there. So potentially could be a while before we get back there, but open to anything at this point, as the market is showing a little bit of near-term strength, but a lot of people are starting to get a little bit more excited again. But as we know, it's a dangerous game with that as the hope comes back in. That's generally when the market tends to turn back the other way again. So at the moment, just basing on short-term market breadth starting to show a little bit more positivity. It is starting to look a little bit better, but incremental moves. We're still in a stage 4 decline. So at the moment, a couple of closes above the 50-day moving average doesn't mean too much yet. So we want to be looking at individual charts to see if we're actually getting that show up across the market, or whether it's only isolated in a few small areas. So Nasdaq Composite showing a little bit more strength than the S&P 500 in the near term, but it does have a lot more to make up in terms of it's still 15% below its 200-day moving average compared to the 10% in the S&P 500. So even if it's still got 5% to catch up there before it's even in the same bit. But you can see at the moment holding 2 days above the 50-day moving average. So small change of behavior. We haven't seen closes above the 50-day moving average since back in that March period when we had that short-term advance where people got a little bit more positive but again, obviously topped out and rolled over again. We're still in stage 4. If we look at the weekly chart here, you can see there's a little bit of a minor change of behavior. So again, not seen since back in March time, but we could be starting to see a potential upswing back towards the 30-week moving average, or up towards that 200-day moving average. So counter trend rally at the moment underway, but whether it holds or not is obviously yet to be seen. Look at the shorter term intraday chart for the Nasdaq 100 here. So I show this one occasionally. You can see it's started to get above the short-term resistance from the cloud resistance here, starting to eke out a short-term base over the last 2 months. So you can see the sort of broad structure it's been forming, with a terminal shakeout type move down here and higher lows starting to form, starting to break through some near-term levels. So a little bit of a change of behavior going on at the moment compared to what we've seen over the last few months, but it's still got a lot more work to do. But you can see the relative strength down here starting to slightly outperform the S&P 500 in the near term. As I said, it's still got a ways to make up. Russell 2000, similar to the Nasdaq Composite there, 2 days above the 50-day moving average now, breaking above the near-term pivots, so showing a little bit more relative strength in the near term versus the S&P 500, as you can see here, but still below the zero line there. And as with the Nasdaq, it's got further to go to get back to that 200-day moving average, but is doing better than the Nasdaq there in terms of only 11% to the 200-day moving average, so relatively shorter distance to recovery, but lots of overhead resistance in this one. Go to the weekly chart, we've got that massive stage 3 range above in order if it does manage to rally back up. So even if it does have a strong rally, if it starts to butt into this near-term resistance up here, it then potentially could start to pull back again at that point. So lots of work to do on these indexes at the moment. So looking to see what's going on in the individual stocks and what areas are showing strength. So as at the moment, as we said, in the sector rotational bit, it's generally groups that you don't really want to be leading at the moment. So we have seen a short-term change in the last few days with some tech stocks starting to come back, with semiconductors especially being strong, and some of the software names showing some strength, with some beaten down names having some really big moves as well, with some of the earnings starting to come back in and being well received in the near term. But it's tending to be, over the last month or so, it's been the healthcare group and the staples have been leading, especially in the near term. We've seen the biotechs and the pharma stocks over the last few weeks or so have been strong, but they've been consolidating over the last few days as the tech stocks have started to take the lead a little bit. Look at the VIX. You can see just coming in at the 200-day moving average at the moment, so just closing slightly below it today, as the S&P 500 made a slightly higher high. So we need to see this continue down into the lower zone below that 200-day moving average to get more positive.